Welcome to the BNB Investing Podcast for real estate investors. Fix and flippers and realtors exploring investment options with Airbnbs and short-term rentals through acquisition, leasing, or management to generate consistent monthly revenue. Join us for a chat with experienced and successful short-term rental investors to hear their story of how they got started and created wealth by building scalable businesses. We also explore various service providers and lenders that help make our businesses more efficient and maximize revenue in this awesome sharing economy. Welcome your host, Rich Monroe.
Hey everyone, Rich Monroe, BNB Investing Group. Thanks for jumping on to the podcast and Facebook Live this week. I am super on this topic. A lot of us have been wondering kind of what is involved with the 100% bonus depreciation and how that works and how it applies to short-term rentals. And so I've got my friend Bill Hampton here today that's going to kind of do a run through and break it all down for us. Bill, thanks so much for jumping on.
Well, Rich, thank you for having me. It's a pleasure being here. I know you're one of the famous short-term rental gurus, and it's an honor to be here in your presence and with your podcast.
Awesome. Well, I appreciate it. Give us a little bit of your background, and then we'll kind of dive in from there.
Sure. So my background is I'm a tax strategist. I own a firm called Hampton Tax and Financial Services. My firm does tax return preparation, tax planning, LLC formations, et cetera, and mostly for real estate investors. About 95% of our clients are real estate investors, and I'm a real estate investor myself. I have 16 years experience doing taxes, and prior to that, I worked on Wall Street, and I was a licensed financial advisor. So I bring financial planning and tax return preparation skills to the table.
All right, very cool. And tell us a little bit about your real estate investing. What have you been doing with real estate?
Sure. I've been a real estate investor since 2010. I'm a buy and hold investor, and I have long-term rentals. But I work with clients who have short-term rentals. I work with real estate agents, clients that do flipping. So anything in the real estate space, we specialize in real estate taxation.
All right. Awesome. And so how are you liking the long-term rental model? Is that working out for you?
Absolutely. I got in at a really good time. 2010, there were some foreclosures out there. I was able to get good deals, and it's really worked out for me. We have some good cash flow, had some good long-term tenants. Actually, one of my tenants has been with me since 2012, so going on 13 years. So I've been lucky. I haven't had to do a lot of turnovers or evictions, so real estate has been very good to me.
Great. And so I'd really like to, before we kind of jump into all the details, if you can just give folks just a general description and overview without the bean counter terminology, so we can kind of understand it as to what we're talking about here. What does 100% bonus depreciation mean? And with the recent changes with the big beautiful bill, can you kind of break down just kind of a high level summary for us to get started?
Sure. So there are a number of things that you have to do to be able to qualify with the short-term rental loophole and the new 100% bonus depreciation. So the first thing is you have to have a short-term rental. That means the property has to be rented out for 7 days or less. That means that's your average stay. So can you have longer stays? Absolutely. But your average stay has to be 7 days or less. That's number one. And that excludes, your long-term rentals where your tenant stays and signs a lease for a whole year. And also excludes, for the most part, midterm rentals where you're renting it out for 2-3 months at a time to, some nurses or something like that. So you get your short-term rental, you get it ready for rent, you get it, your furniture, you get, what else? Your supplies, sheets and everything. You get your cleaners in place, et cetera, et cetera. So great. You close on the property. You have it ready for rent. And then what you want to do is you want to contact, an accountant that can help you do what's called a cost segregation study. So cost segregation study is basically you're going to have a firm, a team of engineers that come in. They view the property. They take pictures on the inside and the outside. And then what they do is they place a value on all the components in the house. That means they'll place a value on the HVAC system, the plumbing system, the electrical system, the painting on the walls, carpet on the floors, or laminate if you have that, kitchen cabinets. Basically, they break everything down to like the outlets and the electrical sockets. And they put a value on those items. And that's going to be based on, the value of the house, based on where it's located. And then once they put a value, we can break down the components. So what happens is that with 100% bonus depreciation, you're already going to depreciate your property. If it's a long-term rental, the depreciation period is 27 and a half years. For short-term rentals, the depreciation is 39 years. Now, the benefit is most investors don't hold on to your properties for 39 years. And
Right.
so that means you'll be leaving depreciation on the table. With a cost segregation study, you break down the components, and that allows us to depreciate some of the items more quickly. So you're not really getting extra depreciation, you're just getting depreciation in an accelerated fashion. That means you're getting it quicker. So instead of waiting 39 years to depreciate the carpets, we can get 100% bonus depreciation, depreciate them over 5 years. We can get, same thing with other items like ceiling fans, refrigerators, stove, ovens, etc. All of those items can be depreciated on a quicker time frame. So that means you get your money faster. So instead of waiting 39 years, we can basically do a cost segregation study and get about 20 to 30% of the value for our clients in the first year. So let me give you an example if you run the numbers. Let's say you buy a $500,000 short-term rental. 20% of that, which is conservative, is $100,000. We can get you with a cost segregation study and the bonus depreciation, we can get you a $100,000 tax deduction in the first year. So, and it could be even higher.
So that's big. So let's break that down just a little bit for folks. So when you say tax deduction, so if I'm a W-2 employee and my income, my taxable income for the year is 200,000, just to pick a number, and I'm gonna get taxed for that tax year based on $200,000 in income. The tax deduction that you're describing allows you to basically reduce your income down to 100,000 less the 100,000 that you're taking as depreciation. Is that correct?
That is correct. That's the way it works. You get a significant tax deduction based on that accelerated depreciation or getting depreciation sooner, and that can offset your W-2 income and significantly lower your tax liabilities for that year.
So in that simple example, it could potentially cut your tax liabilities in half, essentially.
Absolutely. And in that instance, if you're making, $200,000, you're going to be only getting, it's going to reduce your taxes by, $100,000. That's a really, really big tax break. And if you're having a more expensive property, it's the bigger the tax break you'll get on that property.
Now, the 20% number, is that basically just a measurement to cap so that you can't take any more than 20% of the value of the property?
Well, that's an estimate. With cost segregation studies, it's not an exact science. So I tell my clients to expect between 20 to 30% of the value of the property.
But you're still going through and checking the box on what those qualified items are to get up to that estimate of the 20%, right? And so like you mentioned, it could be staging furniture, it could be supplies, it could be appliances, light fixtures, anything that's really not physically attached to the home as far as upgrades go. Am I missing anything besides that?
No, that's sort of the idea. And different items have different depreciation schedules. So for instance, appliances, for instance, carpeting, laminate flooring, they have what we call a 5-year depreciation schedule. So that's going to mean that those items can be depreciated over 5 years. Other items like roofs are going to have a longer depreciation schedule. So you won't be able to write off the roof, for instance, in 5 years. So that's what we do is with the cost segregation, we break it down by item. Some of those items can be depreciated in 5 years, some in 7 years, some in 15 years, and some longer. But the main point is that you can get a large majority of that depreciation up front, and you can get that as a significant tax deduction in the first year. If you, get a short-term rental, put it into service, and, do a cost segregation study.
Now, let's say I'm not a W-2 employee. And I'm a 1099, I'm self-employed. I pay myself through a legal entity, and the taxes flow to my personal tax returns based on how my legal entity does at the end of the year. Is there the same benefit for me as a self-employed person to utilize this?
Absolutely. It's still income, whether you're a W-2 or whether you're self-employed at 1099. And again, if you make $200,000, you would still get $100,000 tax break on a $500,000 property. That's a estimate.
Now, if I'm a short-term rental investor and I've had a pretty aggressive year, and let's say I bought 10 properties, and I've got short-term rental revenue, but then I've got 10 new properties I've just set up that potentially I've got to be able to offset. Is there any limit on a maximum, or as long as it fits the qualifications that I could do all 10 properties if I wanted to in the same tax year?
You can do cost segregation studies on all of them, but first, I wouldn't recommend buying 10 properties and trying to put them all in the service in 1 year. That's a heavy lift, for most people. If you have a W-2 job and you're trying to manage 10 properties, that can be a little bit difficult.
Well, my example, Bill, is someone that's self-employed. That's not a W-2, right? So I'm doing this full time. I'm an investor. I'm buying properties and I'm building my portfolio, and I have a pretty large, income for that year. But, if I earmark 10 of those properties as short-term rentals, I could certainly still take advantage of what I'm after is that there's not a cap on it. Like if I'm trying to maximize my tax advantage on it.
No, if you have 10 short-term rentals, you can do 10 cost segregation studies, and you can, benefit from all of those properties.
Okay, beautiful, beautiful. Now, what is the limitation on requirements that, as an owner investor, there's certain number of hours throughout the year that you have to be involved, right? And so let's go back to the W-2 example on that one purchase. And in order to be able to qualify for this, it's not only just the cost segregation study and understanding what items are going to be eligible. It's also that you've got to have meaningful involvement in that investment throughout the year as well. Is that correct?
Absolutely. The IRS has rules called the material participation rules. And those are some of the rules those are the rules that you have to meet in order to qualify. The first rule is that you have to spend at least 100 hours managing short-term rental. That's number one. That's pretty easy. 100 hours in a year is not hard to do if you get a property beginning of the year. The second rule is that you have to spend more time managing that property than anyone else. So that means you can't have a property manager managing the property, and then you try to qualify if you're running it. Also, it includes your cleaners. So that means if you're having cleaners coming in every week, they can end up possibly spending more hours working on that property. In that instance, I would recommend having 2 cleaners so you can split the hours between the 2 of them. And then that way you don't have a situation where the cleaners are spending more hours working on the property than you are.
So when you file the paperwork for the bonus depreciation, you've got to kind of account for the time that was spent during the year. Is it, how detailed does that need to be, and how is that actually verified?
Sure. So I recommend that my clients use a log. There are logs out there that on the internet. There's spreadsheets that I send to my clients and then there are certain hours that qualify for material participation. There are certain hours that don't. So I would recommend they speak with an accountant who's knowledgeable about short-term rentals and knowledgeable about what qualifies for material participation. B, get with that accountant and get a spreadsheet or get guidance on what qualifies and what doesn't qualify, and then make sure you log in your hours on a daily or weekly basis to track that. In case the IRS ever audits you, they're probably not going to audit you as long as you keep good records, but there is always that possibility. And so you want to have that spreadsheet, you want to have that documentation just in case.
Okay, that makes sense. And, as again, in the W-2 employee example, so you're mentioning that they can't have a manager, they have to have more meaningful involvement than anyone else. Can they still delegate some of the work, like maybe the guest communications piece? and they do the maintenance and managing the cleaners. Like, is there still an opportunity to divide and conquer, so to speak, especially if you've got,
Sure.
40, 50-hour week job and you need some backup there as well?
Absolutely. A lot of times what you'll see with my clients is that you have married couples and they can, help each other out in that kind of instance. Since they're both going to be on the tax return, it's very common to have one spouse that is either a non-W-2 employee that manages the rentals, or B is helping out with those requirements. Or they can always, get vendors. Like, for instance, the IRS doesn't expect you to go out and actually fix the plumbing or fix the air conditioning. So yes, you can hire vendors, and managing those vendors and scheduling those vendors will count. And you don't have to necessarily do the legwork yourself. You can have vendors that help you with, the repairs and other items.
Okay. And then those of us that have been familiar with this is not a new thing as it pertains to short-term rentals. And so what's the benefit and what's changed over the last, couple of months when this bill was passed, that's making this a little bit more advantageous than it was before?
Sure. So previously there was bonus depreciation, but it had declined over the years. It started at 100% and it declined, by 20% over the years. So for 2024, if you had a short-term rental in service that year, you're looking at 60% bonus depreciation. For 2025, it was 20% bonus depreciation, and it still is, depending upon when you got your property. So if you got your property January 18th, from January 1st to January 18th, you put it into service and you purchased it during that time frame, you were only eligible for 40% bonus depreciation. But once this new bill was signed, any properties that were purchased as well as put into service after the Trump inauguration are eligible for 100% bonus depreciation. So you're looking at a difference between, a property purchased early 2025, 40% bonus depreciation, versus a property purchased later in 2025, 100% bonus depreciation. And also, this is permanent, so it's not going to go away. So you can still buy a short-term rental in 26, 27, 2028, and you'll still be able to get 100% bonus depreciation going forward, unless the law changes, unless, Congress and a new president decides to change it. But going forward, it's going to be 100%.
Okay. And let's say I know that I'm going to get a pretty big tax hit for the 2025 year. As long as, what is the qualification to be able to have it be eligible for 2025? Is the purchase of the property, as long as it's prior to December 31st, 2025, or is it have to be set up and staged and in service before that date?
That is absolutely correct. So the property has to be purchased after January 19th, 2025. It has to be placed into service after January 19th, 2025. And you have to have it in service. I recommend my clients have it in service for at least a month. You want to have show at least a month of, activity. You don't want to, put a property in service on January 31st for one day, because that could bring scrutiny from the IRS. So I would say if you have a month of being in service and a month of depreciation, you're probably safer than having a 1 day in service on December 31st.
So a good goal, if I need to get a property before the end of the year to be included, is to have that thing closed on no later than end of November, middle of the end of November, and then go live beginning of December, kind of thing, so that you're a 30-day track record as you finish out the year, essentially.
Absolutely. That would be my recommendation. But I don't recommend that people just go out and buy a property just to get any property, just to get the tax break. You want to first, make sure the property is going to cash flow. That's, rule number one. You want to make money. And then rule number two, you want to be able to put it in an area or get it in an area that's going to show some appreciation. I don't recommend buying a property just to get a tax break. That to me is what we call the icing on the cake. The cake is, I'm getting cash flow, I'm getting appreciation, and then the tax benefit is sort of the extra. That's the approach I recommend, because you just want to make sure you have a good investment. You don't want to get a bad investment just to get a tax break. I mean, you can do it, but I don't recommend it.
Yeah, no, I totally agree. I mean, I think like you meant, like the way you describe it is icing on the cake. I think that's it. I mean, I work with investors that are currently looking for opportunities, and if you get it this year, great. If you don't, then next year is another year.
Exactly. It's still going to be
Yeah.
100% next year. It's not going away next year. So there is no, I would say, artificial deadline. You're still going to get a tax break. You just might get it a year later.
Yeah. Now, just so that we're clear on, the type of property, if you basically bought a property that may already be up and running as an Airbnb, and you're purchasing it with the furnishing and everything like that. And I have some examples of the properties we're currently looking at right now, actually. So, obviously I could go in and update fixtures and update appliances if it needed it. Maybe it was dated. But if I'm basically earmarking a part on the closing statement, let's say $34,000 towards the furnishings and supplies to the seller, is that $34,000 qualifiable, or because it was purchased as a part of the property that it's not eligible to do in the cost segregation?
Well, the cost segregation doesn't go by what you necessarily paid. It goes by what's already in the property. So if you buy the property and it has a, marble table or a granite countertops, that's going to be included in the cost segregation, because it's already there. And what we will do is, I recommend my clients, if they buy a property that's furnished, great. But if they're going to buy a property and then furnish it, do the cost segregation study after you've purchased the furniture, after you've got anything you need to add to it to get it ready, and then all of those things will be included in the cost segregation. So it's not about the price or if you paid for the items. It's about can those items be depreciated, and if they're in the property and they're used for commercial purposes or rental purposes, then they are depreciable, and we can put them on the cost segregation study.
All right, that makes sense. And so that's actually good news, because, if you're self-employed and you do this for a living and you're aggressively investing in properties anyway, obviously it's better to buy properties that are already set up than burn up another 30 days of work to stage and furnish them. And so if it's indifferent to the process and you can still take the advantage of it, then, that makes sense for sure.
Yes, if you're in a time crunch and you're looking at one property that needs to be furnished versus one property that's already furnished, yes, I would say go with the property that's already furnished. You'll pay a little bit more, but if that property has a good track record based on the furnishings, then if it's not broke, don't fix it.
Yeah, that makes sense. I know we have a few people that have jumped on. Feel free to throw any questions in the comments if you guys have any, and we'll try to handle those at the end. So Bill, I guess, part of this process, kind of a natural question would be, well, what does all this cost to have, a firm like yours help with the cost segregation and everything that's involved with the bonus depreciation?
Well, sure. So cost segregations are going to vary depending upon the property, but I tell my clients to expect between $4,000 to $5,000 for a cost segregation study. That's, the range, and that's going to vary depending upon where you're located. The prices in New York is going to be different than California. It's going to be different than Georgia. But just factor that in. And then also the price of the cost segregation is a tax deductible expense. So you will be able to write it off at the end of the year as a business expense, just like your other expenses like depreciation, et cetera. Okay,
that makes sense. And how long does it take to get it done?
That depends on a number of factors. So it depends upon when we can get a team out to take a look at your property. So for instance, if you say, hey, I want somebody to come out next week, that's good, versus saying, oh, I'm still getting some work done, I'm still putting some furniture in, that could delay things. But there is no rush. And let me explain why. Let's say you put the property in service on December 1st, and you want to get the cost segregation study done. We can still do the cost segregation study in January and February and then put that on your 2025 tax return, because the tax return is not due until April 15th. So you still would have plenty of time. So it's not necessarily a rush on the cost segregation. It's more like getting the property, getting it in service. And whether we do the cost segregation study on December 31st, January 31st, As long as it's done before your tax return is filed, you're good to go.
Got it. Okay, that makes sense. Are there any items that are kind of gray area or questionable? So like, having staged many properties for short-term rentals, there's a pretty lengthy list of items that we need to fully equip with, right? Everything in the kitchen, your towels, your linens, comforters, your electronics, your electronic cameras, your electronic locks, your smart TVs. Is all that stuff pretty much in one big pile, or you have to kind of go through and some of them qualify, some of them don't?
Well, I would say this. So most of your items are going to qualify. And if they don't qualify for 100% bonus depreciation, they could also qualify for, expensing. So what does that mean? So the IRS allows you to expense certain items if it's under $2,500. So let's say you get a toaster oven. Toaster oven, we might not want to put on a cost segregation study, but we can write it off as an expense. And, because it's a small amount, so you will still be able to get a tax deduction on it. It just may not end up on your cost segregation study because, toaster is only $20. So yes, if you work with a good accountant, they'll find a way to get you the deductions for those items, whether it's on a cost segregation study or whether it's, regular, expense items.
All right, that makes sense. And so, from your experience doing the cost segregation study, is there anything that we should know? Because obviously, as we buy properties and we're doing rehabs and we're making decisions, is there anything good to know ahead of time that we could probably implement one way or the other that would help with this process?
I will say this. Keep tracking of your expenses. That's important. A lot of times investors lose out on deductions because they don't have the documentation. So I recommend using some type of software to track how much you're spending, whether that's on furniture, whether that's on appliances, et cetera, et cetera. There's software specifically designed for real estate investors to track your expenses. So use software. If you're not comfortable with software, use an old-fashioned spreadsheet, but utilize something. Don't just come to your accountant with a envelope with some receipts in it. That is not going to make your accountant happy, number one. And number two, if you lose the receipts, you might lose out on the deductions. So always try to, track everything in software and then have the receipts as a backup. And that's an important, strategy for real estate investors. If you can't track it, we can't deduct it, So you gotta, do a good job on the accounting or bookkeeping side. If you're not comfortable with that, then you may want to look at hiring somebody to do that monthly bookkeeping, especially if you have like 10 properties. That's a lot of, tracking, a lot of bookkeeping, and you don't want anything to fall through the cracks.
Okay. And then just a clarification question. So, a lot of the properties that we acquire typically are full gut rehabs, right? So we're in a lot of cases putting in new electrical, new plumbing. The house might have been originally built in the 60s and 70s. And so we're upgrading, the entire kitchen with new cabinets, new countertops, same thing in the bathrooms with new tile and new flooring throughout. Do any of those items in a full gut rehab qualify other than what we've talked about with appliances and fixtures? Are there any other items that we can kind of add in there as part of this? Sure.
Basically, everything you're doing is that full gut rehab. I mean, you're looking at, sheetrock, you can depreciate, that. You're looking at kitchen cabinets, you're looking at tile, all of those things that go into the renovation of the property are eligible for depreciation and eligible for the 100% bonus depreciation that you would get with the cost segregation study.
Okay, awesome. So in our example, let's say you buy a property for $350 and you're doing $100,000 towards a rehab. You're potentially able to do, let's say it's 70 of the 80 you're able to put in the bonus depreciation, and then you furnish it with $35,000 worth of furniture. And so you're totally able to use 105,000 through the cost segregation to get 100% bonus depreciation.
That is correct.
Okay.
You know, if you can document the work and you have the, you know, the receipts and everything, those are all the expenses that can be depreciated with 100% bonus depreciation. And that's one of the great things about it. That's why everybody's jumping on it, because they're figuring out that, you know, hey, I can get these deductions more quickly than waiting 39 years to depreciate the property, you know, and you're probably not going to hold on to the property for the full 39 years.
No, right. And so with the qualification of it being short-term rental properties only, is there any clawback? Like, for example, you know, I used to be a fix and flipper as well, right? So if you're a fix and flipper and you fix the property up and you run it for short-term rental, you list it for sale, which we do that quite a bit. We'll sell a property and still have it listed as a short-term rental, generating revenue in the meantime, especially some of the luxury and higher end properties that take longer to sell. And so in that example, you know, I may end up selling it as a fix and flip a year and a half later, but during that first year, I ran it as a short-term rental. Is there any issue with me doing it that way? The fact that I sold it a year and a half later, is there any like penalty for that, or any issues with us doing if we were to do it that way?
Sure. So when you sell a property, you're going to have to pay depreciation recapture, whether that's a long-term rental or a short-term rental. And the depreciation recapture is higher on short-term rentals. So in those kind of instances, I don't recommend necessarily selling it outright. I recommend working with your accountant again on the back end and looking at some strategies to reduce your taxes when you sell. For instance, a 1031 exchange is probably going to be the best bet in that kind of situation. You know, work with a 1031 intermediary, work with your accountant, and then sell that property, take the proceeds, and then use that for another property. So you don't get hit with that, you know, depreciation recapture. You want to delay that depreciation recapture as long as possible. And 1031 exchange is probably the best way to do that.
That makes sense. All right, we got a question from Austin. Can property have a cost segregation study done every year?
No, Austin, unfortunately, no. You can only do a cost segregation study once. And I normally recommend doing that in the year that you purchase the property and put it into service, and you get those maximum benefits. You can do cost segregations later. For instance, like I said, you can buy a property in 2024 or 2025 and do the cost segregation for 2026. And so in some cases, you know, clients going forward can do the cost segregation a year later. But it's best to do it as soon as possible, because you can only do it one year. It's a one and done. It's not something you can do it multiple years. But that's a good question.
That is a really good question. That just because that would be a whole nother game if you can do that every year.
Yeah, unfortunately, the IRS doesn't allow that. You get one shot at it, and you get a really good tax break for that 1 year. And you're going to get some depreciation again more quickly. So even if you don't get everything in year one, you're still getting depreciation for the first 5 years, to the first 7 years. So it's really a benefit for everyone that doesn't plan on holding a property for 39 years.
Makes sense. So Bill, is there anything else that we haven't touched on so far that would be helpful for folks to know regarding the 100% bonus depreciation?
Well, there are a few things, a few recommendations that I have. Number one, work with a good agent or a good guide that understands short-term rentals. You know, that's going to help you. And, you know, someone like yourself that can say, hey, this is a process, this is a repeatable process. We can teach you, we can show you how to do it. Okay. You don't want to go out there and try to do this on your own because you don't know what you don't know if you're just getting into short-term rentals. You know, so you want to work with a good agent. You want to work with a good firm like, you know, B&B Investing Group. You want to get a good accountant. Not every accountant specializes in real estate taxation and understands, you know, cost segregation studies. I mean, for instance, if you go to one of your big box firms like the, you know, Block or Jackson Hewitt, you might not get someone who can help you, or at least someone that can understand this. So get a good accountant. Number two, and work with your team to get the best outcome. And, you know, it's not, you know, real estate investing is not a solo sport. You need a team to really be good at this.
No, it makes sense. So for any of our B&B investing members that reach out, are you able to give them a special discount or anything like that can help them along the way?
Sure, absolutely. If someone reaches out to me and they mention Richmond Monroe and BNB Investment Group, we'll be happy to give them a discount. We love to work with investors that are knowledgeable and that are referred to us. We love referrals.
Awesome. So I've got your contact information down in the show notes as well as in the comments. And so for those of you that are watching and you have more questions and want to understand this a little bit better, feel free to reach out directly to Bill. He's, like you mentioned, 95% of his clients are real estate investors. There's not a lot of CPAs that have that kind of concentration that's helpful. It's a little bit of a different world as it comes to investors and regular income folks. So, Bill, I really appreciate you taking the time today and breaking everything down. I think I've got a much clearer understanding now of what's going on, and definitely will be including this as a part of our investment strategy going forward.
Absolutely. I think it's a great strategy. I think it's really good for investors. I think it's really good for high income earners. And if you follow all of the rules, you're going to get some really good benefits from it, from the tax side. And also, you get some cash flowing properties. So it's definitely a good way to diversify your income as well. Most
definitely. So anybody that's watching, if you want to get more details, like Bill mentioned, on how to do the acquisitions and analysis of short-term rentals, I'm happy to help out with that as well. Feel free to reach out to me directly on Facebook Messenger, and we can schedule a quick strategy call to hear about what your goals and objectives are and see how we might be able to help. Bill, thanks again so much. I really appreciate you jumping on and spending the time with us today.
Well, thank you for having me, Rich. It was an honor. It was a pleasure. And we'd be grateful for your time and for the opportunity. And we'd be happy to come back again if, you'd like to have us.
Most definitely. We'll take you up on that offer, Bill. Thanks a lot.
Okay. Thank you.
All right.
Thanks for jumping on the BNB Investing Podcast this week. Please click on the subscribe and like button below. For more trainings, property tours, and content, you can join my BNB Investing Facebook group by clicking below. If you are ready to grow your short-term rental portfolio and maximize your monthly income, you can click on the link below to schedule a quick strategy call with Rich or someone from his team to see how we can help or point you in the right direction. Stay tuned for our next episode and hope to see you on the BNB Investing Group podcast.